Top 5 options trading strategies for monthly income. My name is David Jaffe from beststockstrategy.com. In 2017, I made almost $800,000 with a 95% plus success rate. And I can tell you that the only way that you can statistically make a lot of money in a consistent way in the stock market is by selling options, specifically put options. All right, you can go to beststockstrategy.com, you can enter your email, you can receive $400 worth of free training. I provide my students with the absolute best real-time trade alerts product. If you want to sign up for that, there's a special. The point of you watching this video is for me to provide you with as much value as possible. So the top 5 strategies on how to make money trading options. I try to keep things as simple as possible. The first is selling a naked option. There are a lot of misguided principles and misinformation out there that tells people that selling naked options is risky, when in reality, selling naked options is by far your best strategy on how to consistently make money. And the reason is that you collect more premium, and it's actually extremely easy for you to manage the position in the worst case scenario. If the second option or the second best strategy is vertical credit spreads, but with a vertical credit spread where you sell an underlying put and then you buy a lower price put, that is, in my opinion, substantially more risky because you're essentially throwing money out on buying that lower priced insurance. As a result, you have way less flexibility, have a lot less options, or a lot less flexibility if you want to manage that position. So the first thing that you should do, and the best strategy by far, is sell naked options. An example of this is Facebook right now is selling at around $175 a share. You would wait until Facebook falls to around 170, then you would sell a put option with a strike price of around $158 and an expiration of 5 or 6 weeks out. This trade is profitable around 98% of the time, and by selling a naked option with one contract, if you have an account size that's less than $10,000, I wouldn't sell more than 2 contracts. If you have an account size that's between $10,000 and $30,000, you can sell 3 contracts, but it's very easy to manage. In the worst case scenario where Facebook falls to like 150, you will end up owning Facebook around at a price of $158 less the premium that you received, and this is only going to come into play around 3 out of 100 times. The remaining 97 out of 100 times, you're going to collect and keep 100% of the premium. And in those 3 out of 100 times, you can easily manage and roll that position. So by far, the best strategy is to sell naked options. The second best strategy is to use vertical credit spreads. Vertical credit spreads, in the example that I gave before, is, let's say you would sell the same strike price, $158 on Facebook, and instead of having it be naked, you would then buy a lower priced put option with the same expiration. Let's say you would buy the 150 strike price. So you would sell a 158 put option on Facebook, and you would buy the 150 strike on Facebook. The only advantage to using a vertical credit spread is that it reduces your buying power. So it reduces your buying power reduction. So for example, if you sell the naked put on Facebook with a strike of 158, your buying power is going to be reduced by around 20% of that. So that would be around a little over $3,000. But if you instead would use the vertical credit spread, where you would essentially bracket Facebook into an $8 stock, which is the difference between the put that you're selling at 158 and the put that you're buying at 150, that's only $8 or $800 in risk. So as a result, each vertical credit spread that you sell, you're only going to reduce your buying power by around $160. The reason why I don't like vertical credit spreads is people inherently are greedy. That's just our human nature. So what students do is they end up selling, instead, if they would sell 1 or 2 naked options, they end up selling like 30 vertical credit spreads. And then 3 out of 100 times, Facebook will drop to like 153, which is that no man's land, between the 158 and the 150, they'll get assigned those options, and then their broker will force them to close it at a huge loss, and they will lose all of the money that they made on the 97 previous winning trades. As a result, I do not recommend that you trade too many vertical credit spreads. Although if you have a small account, you definitely should use vertical credit spreads, and I still use vertical credit spreads on very expensive stocks like Amazon, but I would just say that it requires a lot more discipline, and it's also much more difficult for you to manage and roll the position because you're essentially throwing money away by buying that lower price put option. The third best strategy is to sell covered calls on stock. So if you own 500 shares of Facebook, you can simply sell a covered call and you would make it an out of the money call option. So if Facebook is trading at 175, you can sell, if you're long 500 shares of Facebook, you can sell 5 calls of Facebook with a strike price of 185 and expiration of around 3 or 4 weeks. In the worst case scenario, those shares get called away from you. I also don't I don't own any stock. I don't trade stock at all. All I do is trade options. So I'm not really a big fan of selling covered calls, but if you are, long short equity and you take inventory and ownership of stock, then I guess selling covered calls can add around 5 or 10% to your bottom line every single year. The fourth option, there really isn't any. I mean, you want to focus on the things that are going to make you money by being extremely disciplined. So I guess the fourth strategy is you should really reduce the number of underlying stocks in your watch list to no more than like 10. If you have an account size that's between $5,000 and $10,000, you should trade at most 2 underlines. You should trade like Facebook and Bank of America, Facebook and Boeing, or Facebook and Lockheed Martin, or maybe you want to trade like a gaming stock like ATVI and Boeing or something like that. You want to pick large cap stocks that have a market cap of over $100 billion. Now I know that there's no large cap stock in the gaming industry that has a market cap of over $100 billion, but you want to choose a market leader. So whether it's Lockheed Martin, which is around $100 billion, or Boeing, which is around $200 billion, or Facebook or Amazon or something like that, you want to limit your risk, and rather you want to limit the amount of information that you are consuming. And by choosing large cap underlyings, you're not going to compete on information. So it doesn't matter if you read and spend 24 hours a day reading press releases and reading the 10K and 10Q of Facebook, because you're not competing on an informational advantage. There's essentially perfect information out there, and everything that you read is just purely for entertainment. It's not going to help you make any money. So if you have an account size of below $10,000, you only want to trade at a maximum 2 underlines. I trade around 5 securities. I always have positions on Facebook, Amazon, Lockheed Martin, Boeing, and a gaming stock like ATVI. I also usually have a position in a banking stock like Goldman Sachs or PayPal or Bank of America or something like that. But that's pretty much it. So you want to keep things simple. You want to limit your informational uses. You don't want to listen to fake gurus. So that's the fourth tip, is to make sure that you only trade and you only watch like 2 or 3 or you watch a maximum of around 5 or 10 securities in your watch list, and then you simply get comfortable with the price movement of those securities, and then when it's trading in the bottom half of its range, then you sell a put that's around 10% below its current market price. The fifth strategy that everyone should employ when trading options is to not trade very large and to wait for the specific underlying to be at the bottom part of its trading range. So last month, in July of 2018, Facebook had the single largest market cap loss in its history. It's because we did not chase the stock. In a month or two prior to Facebook falling, it essentially went up from 180 to 218, and it was up like practically every day. It did not provide us with an entry point. As a result, I had no puts that were above $170. And the reason I'm telling you this is you should never chase stocks. You should always wait for this underlying stock to fall in the bottom part of its trading range, of its recent trading range, and then you should sell puts a small amount. You don't want to get too greedy. That way, if in the worst case scenario, like Facebook had in July of 2018, you can easily manage the position. So you don't want to trade too large, and you also want to be patient and diligent, and also you want to be very strategic in the trades that you make, so that you only want to sell puts on positions that are trading in the bottom part of its trading range. You need to be disciplined if you're going to make money, and you can subscribe to the Trade Alert. You can learn more. It's only $19 for 7 days. You can go to beststockstrategy.com, and I'm here to help you. So like, subscribe, click the little bell button so that you're notified of when my videos come out. If you have any questions, leave them in the comment section and I will answer every single one of your questions. This is David Jaffe from beststockstrategy.com, and thank you for your attention and for watching this video.